Hi everyone, in this BitMEX tutorial I will lay out problems associated with trading big size and I will suggest some remedies. The problems that I will touch upon are risk limits and the risk steps increasing maintenance margin, broadcasting a large order in the order book in the context of leaving the orders in the order book for long and in the context of executing near the current price. And I'll also talk about the stop losses. If you like the video, if you have learned something, please give me a thumbs up. Check out the fee discount links in the description below. They will save you some money. While this video is about BitMEX, most of the solutions apply to different exchanges as well. This video is intended for retail traders. If you are a sophisticated entity, I'm sure you know what you're doing already. So let's start with the risk limits and the risk steps increasing the maintenance margin. So risk limits, which you can find here on the BitMEX page with the risk steps and the risk limits, for many contracts they are between 50 and 200 BTC. When your position exceeds that, your maintenance margin goes up, more funds are locked into your position, and your liquidation becomes significantly more expensive. Obviously, we all manage risk appropriately and nobody ever gets liquidated, but the truth is that the market is volatile and the things may go not as planned. The simple solution to this is to split your positions across the different accounts. BitMEX support says that multiple accounts are allowed. If you are short, consider what is your liquidation price and make sure that your position size at that price is below the lowest risk limit. That means that if you are liquidated on XBT USD swap and your position is below 200 BTC at that point, your loss will be 0.4% of the position. And that's the loss which goes towards the liquidation itself. If your position is 500 BTC, you will lose 1.6% of the value of your position. The 0.4% risk steps go all the way up in 100 BTC increments. Massive position limits are available upon request. I think that at the bottom of the 12th of March, the liquidation engine was $300 million long, which is around 80,000 Bitcoins, and if that account obeyed the risk steps, the maintenance margin would have been 316%, which is around 250,000 BTC. Another important point is that that 200 BTC upper risk limit is at your liquidation price. So if you are expecting a liquidation at 15K or let's say 20K, you can open a short worth 400 BTC because at 20K your short will be worth just 200 BTC. If you are long, think about the lowest realistic price. Check the lowest risk limit at that price. For example, if at 10K you think that the lowest possible price is 5K, your XBT USD position should be 100 BTC because it will grow to 200 BTC at 5K. At that point, you'll be liquidated with 0.4% maintenance margin. It's a nuisance, but if you fragment your position between multiple accounts, your liquidation, which hopefully never happens, will happen at the lowest possible cost. Let's touch upon the other issue, broadcasting a large order in the order book. Let's start with leaving the orders in the order book for long. Broadcasting a large order is never a good idea. There are many sophisticated entities having excellent understanding of the order books. They know which orders are market maker orders moving together with the last traded price. They can also spot spoof orders and ignore them. They can also spot resting orders lying in the order book for ages and take advantage of them. For example, these orders will not move over time, and there are some other factors which can be taken into consideration. I can demonstrate my point on the big orders on OKEx. In the old days, the liquidation engine submitted liquidated orders as a single big order. And that order stayed in the order book at the liquidated price until the settlement, and it often took days. And this is how it looked like. These orders were yellow, and sometimes they were really large. It was absolutely certain that this order will not move unless it's filled, and it will disappear at settlement on Friday and transform into a clawback, which will take money from the winning traders. It was common for traders to front run that order, and these liquidation orders could have been really large. The biggest, the record liquidation was $415 million worth of contracts. So that was a massive Bitcoin position. So let's say that a $10 million sell order rests at 7,152. A trader would submit his 5 million sell order one tick lower, let's say 7,151. The price would climb up to 7,151, for example, eat 2 million of his order and then reverse down. He would then rebuy lower down, replenish his 5 million order at 7,151, and then rinse and repeat until his 5 million order gets completely filled. With a bot or even with a standard exchange interface, at a point when his order filled completely and the 10 million order about him started getting liquidated, not liquidated, but filled, he would market close his order and close his order into that bigger order just above him at near zero loss. And this strategy had a really good risk profile. The major risk was that when his order gets filled, the order above him gets filled immediately. But very frequently, a large order would take a while to get filled. So the same thing can happen to your order. Someone might try to front run it, and then when he knows that the price is moving against him and that the price will not reverse after eating part of his position, he will close his order into your order just above him. Similar situation can happen even if you fragment your order. Now, the remedy that I suggest is to use stop orders as a way for you to hide your orders. A very simple thing would be to submit stop orders at, let's say, $10 intervals in a following way. And let's use the testnet just for educational purposes. So at 10K, at 10K last price, you trigger $10,009.5 limit sell, which is maker only. So let's say you are selling 100,000. That is 100K. We are on Ethereum. Let's move to Bitcoin. So 100,000 sell. Limit price will be $10,009.5, and the triggering price would be 10,000. And you submit post only, triggered by the last price, take profit sell. In that situation, when the price reaches $10,000, BitMEX will automatically submit a maker only order at $10,009.5. That will be the first of your orders. At $10,010, you when the last price reaches that level and your order has already been filled, you trigger another sell at $10,019 and so on, and you can just continue that until you have 1 million or a few million position. You are only allowed 10 stop orders on BitMEX, so you have to use them responsibly. Entities monitoring the order book have no idea how many of these orders you have hidden. Bear in mind that you can only use up to 10 stop orders per account. This strategy has another benefit. If the price is rapidly moving, often during the overload, The price moves so fast that it jumps $10 in a single tick. This would result in your order being rejected because it's maker only, and it wouldn't be, it wouldn't be a maker, it would be a taker when the price moves too fast. While this could make you miss the very top wick, more often than not it will prevent you from selling in the middle of a pump, and you might be able to sell at a higher price if there is overload at the moment and very rapid price action. Now, another topic that I'll touch upon is broadcasting a large order in the order book while you're executing near the current price. So these are the conditions when you don't want to leave an order for a while, you want to sell pretty much now. Don't put the full order into the order book. Split it into the smaller ones, submit a small part, wait until it gets filled, and then submit another. That will hide your intentions, and some big entities will not know that you are a big seller and you want to sell now. Stop losses for big orders are tricky. And by stop losses, I mean orders that close your position when your position loses money in a way that you don't consider tolerable anymore. So best to have these stop losses for big positions far away from the current price and to use them in a discretionary fashion with a good discipline. You can set some rules in your head which will be price and time based, and that will allow you to exit slowly. You can implement some more factors, so you may close when there is a big premium or a big discount or whatnot. It will prevent you from selling at the tip of the wick, but the discipline can be tough. So I would suggest having some discretionary stop losses over some kind of hard-coded stop losses which can wick you off, so you can be forced to sell at the very bottom of the wick. You can fragment your stop losses just as I have described already with the stop orders to prevent the slippage. So rather than having one stop loss closing the position altogether, you can have a few of them next to each other, and maybe that will save you some money in slippage. Thank you very much for watching. If you liked it, please give me a thumbs up, leave a comment. I answer the questions in the comments. Please subscribe and check out the fee discount links in the description below, which will save you some money.